on it. Evaluate and prioritize significant risk of material misstatement or audit risk. So the first thing to be done, that is materiality. Calculation and justification has 3 marks. Okay. So, for example, and it is told to you people in the exam that materiality will be based on profitability, revenue, or sales, or total assets. Whatever they say. First of all, you should know that the materiality is 0.5% to 1% of sales, 1% to 2% of total assets, 5% to 10% of profits. Now, so this is materiality. Benchmarks. These are materiality benchmarks. You should memorize it. So you need to mention when you are discussing materiality. For example, they say the materiality will be based on sales. You will say that as per the guidance from the partner, materiality will be based on sales. That is 0.5% to 1% of sales. And then you will calculate. First of all, you will state the benchmark. Then you calculate the benchmarks, lower and upper both. And then you choose one. Which one is good? Then you justify why you have chosen it. If you choose lower, materiality should be at set of lower range. It is a new audit client where controls weaknesses are there in the scenario. Incorrect accounting treatments are there. Too many accounting estimates are there. There are indicators of management bias. Now, indicators of management bias. What they are? Where bonus is attached, company is going to be listed, some loan covenants is attached, company is applying for some loan, company is going to issue new shares, directors are going to sell, CEO is going to sell his own shares, some family members' shares. So they are indicator of management bias. You need to look for these points from the scenario and utilize in 2 to 3 lines as justification that why I have chosen the lower benchmark. But you must have to use exact specific information from scenario. Materiality may be set at the higher range if it is an existing client and above risks are not there. Things are stable. All depends upon your logic. Same question. One student is writing that I will use lower benchmark and justifies that properly. The other writes, I will choose upper benchmark and justify that properly. Both will get marks. It is not necessary there is one correct answer. No. There is no one correct answer. Now, so justification. You see justification. Examining team will credit for any reasonable explanation. And they have to justify the response from scenario information. This is very much important. You cannot write generalized points there. You can't write. Remember that. Then there is 1 mark available for prioritization of risk. Audit risk or risk of material misstatement. This is for justifying the reason. Actual range of different answers are acceptable. Okay, that which risk is higher? 2 ways. Prioritization can be done by 2 ways. One, second, I do it by both ways. Order your answer in the priority. Means that the first risk of material misstatement, highest risk, second, third, fourth, fifth, like that. Or conclusion. I want you to write conclusion. That in the conclusion paragraph, you, at the end of the question, you say that this the first risk, highest risk of material misstatement is involving the biggest amount and possibility of occurrence. Second is the second number, third, fourth, fifth, like that. Next. The next is using analytical procedures to evaluate risk of material misstatements. Analytical procedures or audit risk. So you have, sometimes they ask you to calculate, sometimes they ask you. But if they don't ask you, but financial statements are there, still you can calculate and discuss. Each calculation is worth 0.5 mark. And total marks available for such ratios, trends calculation, and discussion is normally 3 to 4 marks, maximum 5. No marks are awarded for working or writing formula. Simple, calculate and give. You have not to show calculations. And use those calculations to, this is the task basically. This is the task basically, that you have to evaluate audit risks. And one more thing. Some students think we have done calculations. We have written the ratios. We should get marks. No, you will not get. Marks only will be awarded when they are, yes. This is the same case with the risk of material misstatement. I will be discussing in a few minutes. An audit risk. When you are explaining your audit risk, I say MTI or MTRI. Materiality, treatment, and applied to scenario. But when you don't apply it to scenario, you don't get marks. This is unfortunate reality. When you don't apply to scenario properly, you don't, examiner says you have not solved the scenario. Why should I give you mark? Although in the marking scheme, they have mentioned that materiality 1 mark, and accounting treatment 1 mark, then risk 1 mark, impact 1 mark. Okay. But you just discussed what IFRS is saying. And you are not applying to scenario how risk it is applicable here, which item is correctly recorded, incorrectly recorded, or maybe incorrectly recorded. You are not discussing that. How? You're not discussing it on the scenario. So you are not going to get marks. That's confirmed. I hope you got the idea now. So accounting issue. So in the risk, so we are discussing risk of material misstatement. Yes. So analytical procedures we have discussed. Accounting issue, which I'm discussing right now. So each accounting issue, this is one of the favorite point in the risk of material misstatement of examiner and even mine as well. In my opinion, this is the point where you can score maximum marks. So each accounting issue 3 marks. But in exceptional cases, exceptional, 4 to 5 marks may be there, where you can discuss more than one aspect. For example, they have given to you revaluation of asset and lives of assets as well. Now, IS 16 it is. So 2 aspects are there. You have to discuss revaluation of value and their useful lives as well. Now, 2 aspects. It may be 4 marks or 5 marks. To earn the full marks, you need to properly explain the risk. What you need to do? Identify information from scenario that create the potential risk. If numbers are provided, compare. So start with materiality, M. Materiality of the issue. Compare it with the benchmark. It is more than that or lower than that. This helps to assess the significance of risk. So wherever you find answer, please leave that. Don't try to memorize examiner answer. The structured approach, I'm again saying, I'm sorry to say, this has happened with me. I don't know. I have done 10 questions with students like this. Then I said, write this answer. I don't know why they are not following my guidance. Please now listen, everyone. You might be saying Mr. Hamza is actually scolding us. No. Actually, disappointments that I have taught 10 answers, 10 questions that how to write answer. And when I ask them to write answer, they don't follow it. Simply, they are writing by their own way. So first of all, for each accounting issue, for each matter, what is the thing to be discussed? Forget about all answers written by all kids, all examiners. What is the first thing? Materiality. The first thing is materiality. Discuss that. Compare it with the benchmark and say it is material or not. If it is more than that. Or assess whether it is material by nature. Now state required accounting treatment from the relevant accounting standard. Only relevant. Not everything you know about that. No, please. Relevant to the aspect discussed in scenario only. What IFRS says. For example, it is the valuation of investment property. You can say investment property is a standard. Number of things are there, but they're talking about valuation. You say you will write as per IAS 40. Don't remember the number, leave it. As per IAS or IFRS, investment property can be recognized as cost model or fair value model. And it should be consistently followed across all investment properties once applied. Now, if the case study provides specific information, very important, comment on it. If case study tells how the company has recorded, now comment on it. It is correct, incorrect, why it is correct, why it is incorrect. I repeat, note down this sentence. If case study provides the treatment that how company has recorded, comment on it. It is correct as per that guidance, IFRS. If it is correct, how it is correct? Why it is correct? If it is incorrect, why it is incorrect? And then afterwards, state the risk and impact. That if it is incorrect, sometimes what will be the impact on financial statements? Which items, specific items in financial statement are understated or overstated? Or second case is if that is silent. Now come here. If so, IFRS, you have give relevant treatment to scenario from IFRS, only relevant. Now, two cases may be there. Scenario has information about details of treatment done by company. Treatment done by company. Scenario has incomplete information about treatment. Both types are there in exam. Now, the scenario is giving treatment, then two possibilities are there. It is correct or incorrect. In both cases, apply IFRS knowledge. Apply to situation and justify why it is correct or incorrect. Why it is correct or incorrect. And then tell impact on financial statements. Which item of financial statements, specific intangible assets, expenses, amortization, profit. The more specific you can do, the better. Is understated or overstated? Which item? So you see here, if I say materiality, treatment, this is treatment. All this is treatment. And impact, MTI. Now come the other side. Scenario is has incomplete information about treatment. Then what to be done? Again, explain what incorrect treatment may have been done. May have. This is called risk. And then resulting impact on financial statement. Again, same. Which items, here we said is overstated. Which items may be misstated because there is a risk. May be understated. Which items are overstated? Now, 3 times a day. The next 3 days you have to read it. Because if you cannot understand it, it is going to hurt 25 marks of your paper minimum. If you don't apply it. And 25 marks hurting means you are, I'm sorry to say, God, you have failed your exam. And this is the problem with my students, not all, that when I ask them to write down, this is my pain. Then show me answers, they don't apply it. I say, evaluate your answer against this criteria. When you write answer, find what you have not done. in it. Simple is that. Now, come here. Next. Because how 25 marks? This is going to be utilized in the another question in exam. Comment on the matter to be considered in section B as well. It is going to applied over there as well, this knowledge. Now, so some risk may be up to 2 marks. No much detail available. For example, new audit client, company is going to be listed, directors bonus based on profit. Okay, accounting system was weak controls, like that. Next. Now, this question is becoming common. In the last 4 past papers, it was tested in 2 papers. Even the one first question we have to do today, which is from the September-December 2024, one part is on it. Justify why each issue has been identified as significant risk of material misstatement. Again, the same way to calculate and justify materiality. Just a minute. I think there is some. Yes. Justifying significance of risk of material misstatement. So candidate need to apply, demonstrate the understanding of risk, how it arises, how the audit will focus on those issues which are likely to cause misstatement. Providing answer where specific answers are not well explained and lack depth won't get marks. What is significant risk of, what are the justification of significance? Where estimations are there, judgments are there, uncertainties. For example, I was just going through your mock, pre-June mock. They have included a question in it which was tested in 2024, I think, June. They have included that question in it. They justify the risk related to inventory. I have done this question in my class, regular class, I think. So when they ask it, so you know inventory, there is work in progress, estimation, judgment, uncertainty, complex calculations, work in progress. So find that material amounts involved. Why it may be misstated? Because it involves material amount. Management can manipulate it to achieve certain tasks. Importance of some disclosures may be missing. For example, disclosure about some court cases, some breaches of laws and regulations. Significant. Sustainability. There may be management biases involved. You see here. There may be complex criteria, IFRS 12, IS 12, IFRS 2, IFRS 5. So these items may be there. Justify significance. To find these things and justify it is risk and explain why it may be misstated, why and how. Lack depth means why it is a risk. It is involves complex transaction, complex criteria, judgment, uncertainty, management bias. So they may have applied incorrect treatment. They may not be able to follow it. Okay, now, so then comes the business risk. Business risk is the business risk which have the result. What is risk? Which risk is adverse? I'm telling you that if you do not learn accounting issues, how to write them, if you do not learn justification, this one means this one. If you do not learn this, your paper will be affected. Significant business risk, which may result in significant consequences. So for business, what are the significant consequences? Adverse impact on these things. Adverse. And amount is involved. So while explaining the business risk, it should be explained as a risk the directors of business will care about. And it will have impact on these things, negative impact, if it is materialized. So, structured approach. Identify information from the scenario which is creating the risk. Now tell me, fire erupted at the business premises due to control weaknesses. Is it a business risk? No, it is not. Because it has already erupted. Business risk is something which yet has to occur. The risk which has already occurred, that is no longer a risk. That is a reality. That is a fact now. Then explain the impact on the operations. Specifically impact. Discuss severity by quantifying the amount where possible. Very important, very important. How the impact could become worse. This is called risk scaling. It has professional marks. How 2, 3 risks collectively join and become adverse situation. Now, if you are reading your answer and you have to utilize scenario specific information and you have to discuss it in depth again. If you are not utilizing specific information, you are not discussing in depth, no marks. I'm sorry. There won't be any marks. Next. Students, I will be moving towards the past paper, the latest one. Just a minute. And we will be solving the question on that. Let me open ACCA Study Hub. Here we are. Oh, sorry, it's AFM. Sorry. Opened one. Yes. Here we are. September, December 2024. Hard company. I would suggest you, please open everyone this. The requirement is here in front of you. First of all, this is the background information. It is 1st July 20x5. You are manager in the audit department of Broadway Company, a firm of chartered certified accountant responsible for the audit of Hart Group. For the year ending 30th September 20x5, the group, a non-listed entity, owns and operates 50 theatre, which stage third-party theatres production, including musicals and plays. So information is available. These are the exhibits. Non-listed entity it is. Yes. You need to start planning the audit of the Hart Group for the year ending 30th September 20x5. Okay. And then they say, and to help with this, I have provided you with some relevant information. I met with finance sector yesterday to discuss a number of matters including some recent business development. When determining materiality, please use revenue. What is the benchmark? 0.1%, 0.5% to 1%. Okay, the first requirement, using all exhibits, evaluate the significant business risk to be considered in planning the audit of Hart Group. The significant business risks. Okay. Then using exhibit 1 to 3, evaluate and prioritize significant risk of material misstatement. Now they have limits. This is very much important. You cannot write business risk from any other exhibit here. You need to determine and apply an appropriate materiality threshold in your briefing notes. Now focus on any other thing. You are not required to consider risk of material misstatement related to acquisition of Molten at this point, as it will be dealt in part C below. Okay. Now part C is here. You see here, 12 marks, this, and 12 marks. 24 marks are directly on the risk of material misstatement. Direct. And if I add the other indirect marks, it may become 30 to 35 marks. That's why I say, if you don't prepare it well, God forbid. And students, the worst thing you can do is that I want to complete everything in paper, but I don't write correctly for any part. I'm sorry to say. Majority student focus is, I want to complete the paper. Okay, but what you are writing is correct. If you are not writing correct, not accurate, solve 100-mark paper, you may not get 40. And I know my student who solved 75-mark paper got 65. I know my students, number of my students. And I know most of my students who didn't practice well, who didn't focus the why I'm saying, it's all 100% paper they didn't pass. I know that. So please try to understand the severity of the issue. That's why I'm repeating again and again. You might be thinking Mr. Hamza has gone crazy today. Yeah, it is like that. Okay, now, so this is the second type of question. The group was formed during the year in the parent company, Hart Company, acquiring its first subsidiary. Therefore, this is the was formed. This is the first year the group will prepare consolidated. First risk of material misstatement is here. Using Exhibit 4, justify why acquisition of Molten, 1, and the goodwill arising on acquisition has been identified as significant risk of material misstatement. Design the principal audit procedure which should be included in the audit plan in relation to Goodwill arising on acquisition of Morton Company. 12 marks. So 6 marks are for procedure, we can say. You should consider all components of management's goodwill calculation. Exhibit 4 in your, yes, sorry, next. Using Exhibit 3, discuss their responsibilities in relation to groups in non-compliance with laws and regulation. In relation to the refurbishment of historical buildings without permission, we will talk about it. Non-compliance with laws and regulation. Now, so students, I would suggest you, I have done the reading of the requirements. Now, please open this and at least read business risk, sorry, using all exhibits in business risk. Yes, so I would suggest you give a reading to these exhibits. Take a few minutes from me, 5-7 minutes, open it and read it well. Open it and read it well, then I will solve it. Be quick, please. Yes, students, now I am going to start discussion. So, first of all, structure of the question. So, to, from, it is like that. So, briefing notes, to and from audit manager, date, and introduction paragraph. The first yes, and the first part is significant significant evaluation of significant business risk. Yes. And the second part is and the B part is evaluation and prioritization of significant risk of material misstatement. And after that, the C part is acquisition of Morton company. See here. And goodwill arising on its acquisition. Yes. And then it has second part, audit procedures. One. Second, okay, audit procedures. And the final paragraph will be conclusion paragraph. Now we have made the structure of the question, because now we will be starting reading the question scenarios, and we will be finding it is for 8 marks business risk. How many businesses we need? We need 4 business risks. We need 4 business risks to be discussed, not more than that. For second part, 12 marks. Out of it, 3 marks are for calculation and justification of materiality. Remaining, we must be clear before going through it. The point is, students are not well clear how much I need to write. They say that they are writing more than required. They waste their time. Write exact, precision. Precision. The answer should be precise. Now, precise means whatever is needed, only that. So now, we will be moving and discussing it. So Hart company, the parent company, owns a number of theater across the country. Each theater is a venue for hire. Third-party theater production companies, which are responsible for the live performances and associated staff, pay a fee to hire the theater for specific period of time. The other services provided by each theater vary and include marketing services, technical assistance, and ticket sales. The group theaters are mainly old buildings which are historical sites of the protected status. Permissions from the appropriate regulatory authority to refurbish will only be given if, yes, the historical features are retained. Now, so this is the history. Yeah. In the past, the regulatory authority has taken legal action where rules have not been adhered to. Many of these buildings are in a poor state of condition and require substantial investment for repair to maintain safe and appropriate access for all visitors. Now, the students, first of all, is the one point I highlighted, the company is expanding in itself business risk. They have acquired the first time company. So the first business risk is the first time acquisition. This is the first business risk. The second business risk is here, the laws and regulation. Which we are discussing. This one. I will simply copy and paste here. Okay. This is the second point. So 4 marks are done. Not done. Identified yet. Financing. The group is owned by venture capitalists who provide a substantial amount of debt financing. Yes. The total debt financing available to the group is $500 million, of which $458 million has been used. As such, the group has high level of gearing and finance costs are significant. Now, so these debts are secured on the properties owned by the group. Okay, there are a number of covenants attached to financing. Now, the covenants cover several financial key performance indicators in relation to liquidity, revenue growth, and operational profitability, including a requirement that operating profit margin does not fall below 6%. Where covenants are breached, the group has 2 years from the date of breach to rectify the issue, or the debt will be repaid. Now, this is business risk as well as risk of material misstatement, both. We have to justify. So it is debt. Covenants. Debt covenants. Yes, debt covenants. So same will be here. But it will be the risk of material misstatement. Loan covenants and management bias, because it will result in that. Sorry. In management bias, they have to comply with that. So angle of discussion will be different. Now, So we have discussed we have identified 3 business risks. Now, the next is here. Yes, one thing here, materiality, which we need to calculate and discuss, which is related to the revenue benchmark. 3 marks. So your focus is marks while solving the answer. Now, projected financial statements and actual revenue increasing by good amount, rather huge amount. You can see operating profit it means margins are decreasing very much. Loss before tax. Okay, losses. Total assets increasing, theaters increasing, investment in the year. Okay. The group has a 5-year program to address the significant amount of repair and maintenance in its theater portfolio. The group does not currently have finance in place to cover this cost of 5-year program and is likely to be reliant on obtaining funding through government grants. During the year, the group spent 20 million on repairs and upgrades to 2 theaters. Now, if you are reading it, if you have read this statement, what should come to your mind? Risk of material misstatement. Which one? Tell me. That maintenance cost may be capitalized, may have been capitalized. Risk. This is skeptical approach. This is called professional skepticism. This includes replacement of seating. Now you have to discuss it. They have given you specific information. You cannot just discuss it one line as a whole risk. You have to utilize the information. Replacement of seating and creation of easy access seating area in addition to routine maintenance. Now it means this needs to be capitalized. Okay, and routine maintenance should be expensed. Permission to modify the building was not obtained prior to working place, and group are in process to obtain retrospective permission for. Okay, now, so let me copy it. Upgrades and maintenance cost. What is it? Upgrades and maintenance cost. Yes. Now, secondly, they have made modifications. They have done, but they have not obtained that permission. It is related to the first point. Laws and regulation. Yes, debt covenants, sorry. Laws and regulation. It is, so you see here, information is available in scattered. This is why I examine there are professional marks for that. That you are utilizing information about one issue spread in different part of the exhibits. It has professional marks. Nothing new. Now, so let us proceed further. So upgrades and maintenance costs. The next government grant. A 15 million government grant has been provided with respect to a 3-year project with the group will work with local schools. The funding period runs from this 1st April 2025 to 31st March 20x8, and any payments are made annually on our 1st April each year. The group has recognized the income of 2.5 million during the year in respect of this grant. As part of grant, the group has targets for the hours spent in local school and number of children who participate. Okay, now the employee running the school on scheme behalf of the group has been absent from the work due to sickness, and as now this is business risk as well as government grant. Government grant. Sorry. So you see here. So we will copy it from here because it is business risk as well. But discussion will be different angles. So how many? 1, 2, 3, and 4. In exam, if you have gathered 4 points for business risk and you think you can write well, stop looking for further business risks. And you see here, come here. There are 12 marks for this part, 3 marks for materiality. Now remaining training, loan covenants and management bias. It is not an accounting issue, 2 marks. Upgrades and maintenance costs, 2 to 3 marks for it. Because not that much, but still 3 marks are possible. 3 marks are confirmed for it. Confirmed. So 3, 3, 6, and 8 or 7. To be on safe side, 1 more point we need. Then it is also, then we start writing the answer. This is how you will save time in exam. Okay? Reading the whole scenario is good. You have read. But identifying all points is not good. Only you should know how many points I need. That's it. Come here. Minimum ticket sale guarantee. A production at the group's Phantom Theatre has suffered poor reviews and ticket sales to date has been significantly lower than projected. This production was due to run for a 12-month period from 1st January to 31st December 2025. The group provided a minimum ticket sale guarantee to the third-party production company for 18 months. $18 million, sorry. Okay, $18 million. Now, Varana sector has estimated a payment of $4.5 million will be required based on estimated ticket sale to 31st December 2025. Okay. This assumes that ticket sale in the second half of the year will improve significantly over the level of ticket sale being made the 6 months to 30th June 2025. The finance sector advised that he will include this as a provision in financial statement at the year end. Now, so students, this is the ticket sale guarantee provision. Yes. This is wonderful accounting issue. Now, enough. If you still think, no, I have to write only 3 points, okay, that's also a wise move. That can be a wise move. How? Find another accounting issue and discuss only 3 accounting issues. Simple is that. 9 marks done. So government grant is accounting issue. So take upgrade and maintenance cost is an accounting issue. But there is not that much discussion on the IFRS. Okay. So that's it. So let us start writing answer now one by one. Come back to the first time acquisition. Business risk. Now, when you are, you have to wire your brain that when you are discussing business risk, what to write. Now, so a bit information of, because for business risk, we need information about new acquisition, 100% shareholding, a small theater, first time they have purchased another company, transfer completed very quickly, no final due diligence report in respect of was prepared. Okay. Now, the next, no fun. This is tricky point about business risk. Tricky point. So some important business risk attached with acquisition, unexpected liabilities may not be identified. That's why I said I need to read it. I need to read it. You see, I found the point. So, Hart Company acquired, it acquired, what is the name of the company? Morton Company. Company during the year. Issue from scenario. And it is first time acquisition by Hart Company. Now, students, the question from you is how it is a business risk. What can go wrong because of it in the business? The first thing, the acquisition was swift and quick, and no final due diligence report on Morton Company was prepared. It was quick. No final due diligence. Risk from scenario. But you have to explain how it is a risk. What can be the likely? Yes. So there is risk, there is possibility that some important aspect of Morton Company, such as liabilities and a cost or other costs, may not have been identified and reviewed at the time of acquisition, which may reduce, which may expose the Hart Company to additional costs not intended. Now you see here. 2 marks are okay? No. You can get 1.5 mark for it. It's okay. But we have to discuss one more aspect at least, because it is such a wider issue. Now, listen. That expected, they have done the investment, acquisition. So they may not be able to, the management, they may not be experienced to deal with the increased size of the business now. They may lose focus on the current business and its performance may deteriorate. Or there may be integration issue of new company with the current business. So yes, so moreover, the management may not able be experienced to deal with increased size of business. They may not be experienced. And may lose control even on existing business of a Hart company, and inefficiencies may arise. Inefficiencies may arise in business, and existing business may deteriorate. Now it is for 2 marks complete. Enough. But if you can discuss another point, for example, a student does not write it, okay, they may write that similarly they may not able to integrate the business of Molten company with the business of Hart company. They may have acquired the company based on over optimistic assumptions and may not materialize the returns. So business risk, enough. So this is enough for 2 marks. There is no amount we can discuss here, no amount. Now, so laws and regulations. So regulations related to the refurbishing the building. And they have taken legal action in the past. And the company has done the modification and it was not obtained. So a persuasive way to write this point for 2 marks. All the data is there. You have to utilize them smartly. Simple is that. So what I'll be doing, I'll be writing the answer. So the group has old buildings of its theaters. And which are historical sites, not issue. Historical sites. And regulatory and permission from regulatory authority is required for any repair to them. Now, so students, here the Hart company has done the modification without prior approval from authorities. They have done it. And now they are in process to obtain approval. Retrospective approvals. Now, this information is all available. I have just selected the relevant information from all this. Now, how it identification of business risk, how it is a business risk, what negative consequences may occur. Now, authorities may not approve the work done if it is not as per their standards. Yes. And rules. And since the modification have been already done, it may lead to fines and penalties to be imposed on the group. Not only if it has not complied with the rules, but because of the reason as well that they made modifications and repairs before approval. Now, and the history tells the regulatory authority. Now, this information, here it is, has taken legal action, has taken legal action in the past where the rules have not been followed. So, potential fines, penalties, may be substantial amount, given the seriousness of the issue, having strain on business cash flows of business and profitability. Done. You see here in-depth discussion. I have seen the answer student, they just write everything in 2, 3 lines. They don't discuss in depth. So this is just issue. This is how it is risk and what consequences and why and how it may arise. Done. Impact on cash flows. So I will be opening the, yes. Here it is. Business risk. Writing the answer. Just compare your answer with it. Identify risk source, information from scenario. Impact on operations, penalties. Yes. Financially impact. We discuss severity because the matter is, okay. So we cannot scale it here. We cannot. So this is how we cannot quantify, but we said it is serious issue. Yes, I will send. Don't you worry. I will upload it. Okay. I will upload it. Don't you worry. Welcome. The next point is the debt covenant. So you see here, information is in front of you. The group is owned by venture capitalists who provides a substantial amount of debt financing. Total debt financing available to the group is $500 million, of which, yes. Let me complete the question. Okay, you can talk to me on WhatsApp on it. Okay, our WhatsApp group. Okay. Okay. The group is owned by venture capitalists who will provide a substantial amount of debt financing. Total debt financing to group is this. Okay, high level of gearing. The debt is secured. Yes. They say this is the covenant. Profit margin, operating profit margin should not fall below this. And where they fall below, they have 2 years. Now we need to get this information from scenario about profit margins. Here, operating profit margins, we need to check whether this covenant has breached. We need to check. Calculate 26 divided by 367. Tell me. Last year. What is it? Tell me, please. Be quick. Do something for me. 28 divided by, good, thank you, 7.08%. And the next year? And the next year, it is 28 divided by 446. So it is 7.1%, right? 6.28%. Thank you. And you see here, the covenant was that it should not fall below 6%. Other covenants are also there. So it is breached. It is breached. Almost. Not breached, almost. It is close. And group is overall loss making. So only and this breach 6.8%. and only 6%. Small increase in the cost, it will breach it. And 2-year period, they need to rectify it. So they need to focus on such actions. Okay. So this is secured. Yes. So we need to discuss it. Let us solve it. Right answer about it. So the group is having significant amount of debt financing from venture capitalists an amount of 458 billion. And several covenants are attached with this debt, out of which the one is attached with operating 6% profit margin. That is group's profit margin should not fall below it. My typing errors, I'm sorry. Yes. Below it, operating profit margin. Now, below it, while it has fallen from 7.1% in 2024 to 6.28% this year. This year. So, which is very close to 6%. A small increase in costs may lead to breach of this covenant. And then group will have 2 years to rectify. Would have 2 years to rectify it, this breach, or the funding will be withdrawn. Now tell me, anything which I have written from my side, I have utilized the same facts available. And the group may need to sell its long-term assets, or else long-term assets to pay off the loan amount. Yes. So the group need to focus its actions to avoid this significant breach of covenants, avoiding significant impact on its financing. Done. So that is the point. Business risk. Actually, we have discussed the impact. We have not said what they need to do, which actions. No, we are not telling them. We just tell them, actually, this is the problem. This is the impact. We are talking the impact. If it happened. So next is the government grant. So the government grant is 15 million, 3-year project. The funding runs from 1st April to 31st. Payments are made on, yes, they're 2.5 million. For hours spent in school and the number of children who participate. The employee running sickness. So program has not commenced. Educational grant. Just 1 second. Let me check if there is any other information related to grant. No. Terms of grant. Target hours and participation. So the government grant is received, has been received for a 3-year project of 15 million related to education, educational work, related work to be done by the group. Now, what is wrong here? And grant condition and the grant condition is has target for hours spent in local schools. And number of children. Number of children who participate. So two grant condition. Two grant conditions are there. and they say that the employee running the scheme was absent due to sickness. The employee running the program was absent due to sickness. Now, what will happen? And it has not commenced during the year. So the might company might be or apparently has not met grant condition related to number of hours during this year. And it may have to pay the staff its salaries at its own cost, and grant may need to be repayable. Yes, having adverse effect on its profitability and cash flows. Yes, it might be possible. Now, done. Business risk is done. The next point is evaluation and prioritization of significant risk of material misstatement. So first of all, materiality. Materiality. Just give me 2 minutes only. Okay, I'll be back and I'll continue. Just 2 minutes. Yes, students, now, I'm sorry. Yes. The point is, the next point is evaluation and prioritization of significant risk. So revenue, the materiality is based on revenue. So for the purpose of these briefing notes, overall materiality will be based on revenue as per the engagement partners instructions as per the engagement partner instructions. Now, so the benchmark is 0.5% to 1% of revenue of the company. So a range of, now we will calculate. We need not to do show calculations. Simply open it. So this year 446 million. 1% is 223. So 220, sorry, 1% becomes, just a minute, 4.46 million. 4.46 million is upper range. Okay. And 0.5%, how much it will be? It will be 2.23 million. A range of, yes, to this. Now, what should be now we have to choose one and justify that. So this is there is new consolidation, new acquisition first time. They have consolidated it. Loan covenant is also affecting it. Two very important factors. We have gone through that. Yes. Hart company has consolidated a new company, a subsidiary, for the first time. And debt covenants related to debt of venture capitalists are at the verge of breach. So there is a high risk of material misstatement in financial statements this year. So now you see here. So materiality level has been kept, considered, decided to be at lower threshold of 2.23 million. You see the justification. Justification. The next point is this benchmark is a starting point for determination of materiality. And as the audit progresses, it should be reviewed with more information and understanding obtained. Yes. Should be reviewed. Yes. Done. 3 marks are done. How easy they are, you see? Now, students, loan covenant environment. I will discuss it in a few minutes. First come to this, upgrading and maintenance cost. Upgrading and maintenance cost. So, 20 million. The group spent information from the scenario, which is material to financial statement being much higher than materiality threshold decided. Okay, materiality. Next, student, the next point is the costs include maintenance costs, and upgrading costs as well. Only the cost related to upgradation should be capitalized. Only the cost related to upgradation and remaining should be expensed, such as I'm sorry, replacement of seating, creation of easy access to sitting areas should be capitalized, being upgrade costs. Now you see, I told the rule first. Now I'm applying to scenario. Student miss here. What is the rule? And applying to scenario. Being upgrade costs. Now, The risk is, and maintenance cost remaining should be expensed. The risk is now, what they have done, they have not given information to us. They have not given us information. This is where details are not given. Now, risk. The risk is that costs may not have been properly distinguished between capital expenditure and operating expenditure and operating expenditure expenses. And operating expenses may have incorrectly capitalized. Now, impact leading to, what will be the impact? Leading to understatement of expenses and overstatement of non-current assets and profit in financial statement. Exact impact. Done. I need to check its marking scheme. I'll be opening, don't you worry. We'll be sharing with you at the end of the question. The next point is another accounting issue, government grant. So government grant, 15 million. First of all, materiality. Has been provided, has been received, which is material to financial statement being much above the materiality threshold. Yes. Now, materiality. Treatment. What IS says. So as per IFRS, if you don't remember the IFRS number, IS 20 it is, by the way. IS 20 it is. As per IFRS, government grants are recognized in profit and loss on a systematic basis against the expenses. Against the expenses or costs, the grants are intended to compensate. Now, students, now applying to scenario. Now, in this case, applying to scenario. In this case, The grant has been received for a 3-year project. The grant has been received for a 3-year project related to education and condition of grant is related to number of hours spent in school or and number of children involved. Yes. Or participate in this initiative. And none of this happened during the year. As what happened? As the staff responsible to run it has fallen ill. So, no costs related to the program for which grant is received has incurred. No cost. But what they have done? They have the group. So no income, grant income should be recognized this year. Now you see, they have given the details of treatment, which is incorrect. Next. But the group has recognized 2.5 million grant income this year, which is incorrect. Which is incorrect. And now impact. Impact. What is impact? There is loss. It should be, and liabilities, deferred income. So it is liabilities. And loss of the year, not profit. Group already are understated in financial statements. This is enough for 3 marks. But if you want to attain some professional marks, we should improve it. What other can be written with it? You can link it with breach of covenant. Now, then it means the covenant is breached, because 2.5 million should not be recorded in the loss is increased by 2.5 million. Operating profit reduced by 2.5 million. So that profit margin is less than 6%. That is breached. So it is highly material due to its nature. One more thing you can write. Since the group has not performed any compliance with any of the grant conditions yet, this may be breach of grant agreement, and grant may need to be repayable, and a provision may be required in this regard. Hence, the liabilities may be now misstated as deferred income of grant may not have been classified as provision of refund of grant, because right note is deferred income. So done. Enough. This has potential to earn 4 marks. This point, I told you. Some points are there like that. Next. Ticket sales guarantee. They have given guarantee. That 18 million will be the revenue from the tickets. So 4.5 million they have to pay estimated ticket sale. So that this year. And yes. And assumption is that in the next 6 months, figure will increase level of sales. Again, it is estimation, which may be optimistic, finance sector may be biased. He may be estimating it incorrectly just to avoid breaching the covenants related to operating profit. This should be recorded, 4.5 million should be recorded as liability, provision. If they do not do it, yes. So we do not know what they have done. They've not explained what they have done, this treatment, whether they have done this treatment. So let us write the answer for it. The ticket sales guarantee with respect to the theater production has been given by the company at 18 million. And as per the estimation of company, the Hart company has to pay how much? 4.5 million. They have to pay 4.5 million. Related to this guarantee, which is above the materiality threshold. Decided, and hence it is material. And hence it is material. Materiality done. Now, this estimation has been done by finance director based on increased level of sales in the second half of year. To 30th June. 30th? Yes. Yes. 30th first, second half is? Yes. Second half of the year. Now, the estimation has uncertainty and potential bias of finance director too. And he may have calculated lower amount of the payment than actually required, just to avoid breach of debt covenant attached to the operating profits. He may have done it. This is called skepticism. Now, and maybe understated. Moreover, it seemed to be present obligation of company, a liability now of 4.5 million, for which a provision should be recorded. A provision should be recorded in financial statements. The risk is that the company may not have, we don't know what they've done, recorded it, leading to understatement of loss for the year and liabilities as well. Now, So it is done. So the fourth point is loan covenants and buys. Now you have got the idea why I left it, because number of points are there. Now, the students, revenue growth and operating profitability. The group has significant funding of, in the form of debt. An amount of 458 million. Having covenant attached with, based on, attached, including, what are the covenants? The covenants are revenue growth, operating profitability, and profit margin does not fall below 6%. Three covenants. Now we will evaluate all these things. Now come here. How much is the revenue growth? Tell me, from this year to this year. Tell me, the revenue has grown by how much percentage? 21.5%. Thank you. 21.5% from last year. Has grown by. And you see here, we have to utilize the information. If we know, they told us the group has in the first, yes, here. There was information, just 1 second, please. Okay, come here. Last year. And the next is operating profit, but operating profit has increased by very small amount, 6.4%. No, not 6.4%, 7.7%. 7.7%. So the increase in revenue seemed to be disproportionate to the operating profit growth. So maybe, so revenues may be overstated, disproportionate. Now, and Company may have recorded revenues of incorrectly just to overstate them, just to achieve the targets set by covenants. That's possibility. Next. Secondly, the operating profit margin has fallen from 7.1% to 6.3%. We already calculated, which is very close to 6% covenant. And if grant income of 2.5 million is reversed, it is already breached. The risk is that the company may have manipulated other costs deliberately, like grant income, to comply this covenant. Now, if the covenants have been breached, the funding, the significant amount of funding may be withdrawn, and it is uncertainty to going concern of the company, for which adequate disclosures need to be given in financial statements. The risk is that disclosures required may not be provided. May not be provided. And these are material by nature. So financial statements may be misstated due to lack of disclosures, lack of complete disclosure. Now, in my opinion, it is again for 3 marks because enough things we have discussed for it. You can see how to utilize information. This is the reason I said I will solve it at the end. And do like this, where you find information, you feel like one item has impact, taking impact from various other points, hold, put that on hold, solve at the end. You will have more clarity. Any questions so far? Tell me, please. It is taking more time, I can understand. But the purpose is solving properly. not solving 10 questions. Now, the next part is here. Acquisition of Morton and goodwill arising on its acquisition and audit procedures on that. We will be doing it. No worries at all. Here is the information. Now, this type of questions are becoming common. On 1st October, Hart Company, the parent company, acquired 100% shareholding in Morton Company. Yes. A small theater company which owns and operates 3 established theaters. This is the first time Hart Company has purchased now. The goodwill calculation prepared by the management and acquisition is shown below. Cash consideration paid 1st October 20x4, 22 million. Deferred consideration, 10 million payable on 30th September 20x6, 8.3 million. Total consideration. Fair value of identifiable net assets, 2, 14.8. Deferred consideration is contingent on the Morton Company theaters achieving revenue targets by 30th September 2026. The amounts become payable on the same date. Management has assumed the full amount will be payable and has discounted this amount at 10%. Now, fair value of identifiable net asset include an adjustment of 4 million in relation to Morton Company's customer database, which is not recognized on the statement of financial position of Morton Company. This was estimated by management of Morton Company. No adjustment has been made in respect of the Morton Company, which was internally generated, but the director did not feel they could reliably estimate its value. Now, so students, very easy, very important, and very easy to be discussed. So let me open and start solving it. I'm sorry. Just give me 2 minutes only. There is some issue at my side. Just a minute. Now, I'm sorry. So Morton Company was acquired 1st October. So it is the first day of the year. So it is easy. Yes, was acquired on the first day of October of financial year, and has been consolidated for a full year. And yes, and has to be consolidated for the full year. So there are number of significant risks arising from its acquisition. Its acquisition. And goodwill calculation as well, which are as follows. So first time consolidation. First time consolidation. So consolidation of financial statements involve detailed knowledge of IFRSs, which are relevant to it. Their intra-group balances need to be eliminated, and goodwill has to be calculated as well. Now, next, the group may not have relevant staff with experience to do so, to do all this, to record all this accounting treatments correctly as per IFRSs. Now, and may not have controls related to it. Controls. Yes. Now, so first time consolidation. Hence, consolidations may be consolidated financial statements may be misstated because of it. The second is now I'm going to open it. Cost of acquisition. Now, So cost of acquisition. So the cost of acquisition includes what is it? What is include? The deferred consideration. The deferred consideration to be paid in 20x6 and you see here, this has been the full amount payable and has been discounted at 10% discount rate and has been measured using a discount rate of 10%. Now, students, the risk is that the discount rate applied to calculate present value may not be appropriately reflecting the the rates which should be applied. Possibility is that means which means that present value of liability, the liabilities may be misstated. Liabilities or deferred consideration. Now I wrote first time misstated. Why? Because both possibilities are there. Now, students, deferred consideration. Now, deferred consideration is dependent upon theater achieving the certain revenue targets. Yes. So, moreover, the deferred consideration is based on the revenue targets. The revenue targets to be achieved by theaters. Now, and it is based, its achievability is subject to uncertainty and estimations, which may also be incorrect. Yes. Now, hence, 8.3 million. Okay. Hence, the cost of acquisition payable may not be the same as recorded, and goodwill may be overstated. Goodwill and liabilities, both, and liabilities. Yes, this is possibility. You see here, nothing is difficult here. Why it is having a significant risk of material misstatement? Next, the second is identifiable net assets. Okay, identifiable net assets. Identifiable net assets. So fair value of net assets would adjustment of 4 million to the customer database, which is not recognized statement of financial position. In customer database, it is directly affecting. Yes, it was estimated by the management of Morton company. So most probably it may be upgraded. So they may be biased, Morton company management. They may have recorded it at a higher amount. And there is no reliable estimation of it. Now, so come here. So fair value of, so yes, as per IFRS 3, on the date of acquisition, the assets and liabilities of the company being acquired are to be measured at fair values. Are to be measured at fair values. So here, $4 million adjustment has been made to the customer database which is above the materiality threshold. You see here, same materiality threshold. Hence, it is material to financial statement of group. This adjustment was done by management. By management of Morton Company. Morton Company. Management. So they may be biased to overstate the value of their assets. Their assets being sold. And since valuation of database involves estimation and assumptions, it is highly likely that it is having a high risk of that it may be overstated in financial statements. Now, next. Moreover, the management, even they are trying to their best to value the database correctly, they may not have the relevant competence or experience to do such valuations. Yes. Next. Next student, they said that internally generated brands, they did not value it. Now, that for Morton Company individual, it is internally generated brand. That's correct. But now it is being acquired. It is acquired by Hart Company. Secondly, the internally generated brand by Morton Company was not valued for its financial statements. And it is correct as internally generated brands need not to be capitalized, but for the purpose of acquisition and consolidation in the group. It needs to be valued and recorded in consolidated financial statements. Now, the next point. The next point is, students, and if it is not recorded by the recorded, the group financial statement has understated intangible assets and goodwill calculated without it has lower value of identifiable net assets, and goodwill is also understated. Now, students, how many marks it bears? Let me check. 6 marks. It is enough. It is enough what we have written. 5 to 6 points. Okay? They are more than enough. Still, we can write on the impairment of goodwill. Now, audit procedures. Audit procedures on acquisition. On goodwill, on acquisition. Now, you see here, very easy to write audit procedures. Audit procedures on goodwill. Audit procedures on goodwill. So, cash consideration paid on 1st October 20x4. So, students, verify or review the bank statement and cash book of company to verify. This payment has to be verified. 22 million paid. 22 million paid. Now they have acquired a company. The board minutes must have discussion on it. So review board minutes of the company. Minutes of the company. To verify board approval of the acquisition. Now, the next is, so 2 procedures are done. Students, now deferred consideration is there. You see here, deferred consideration, 8.3 million. for the present value of deferred consideration. For the present value of deferred consideration, obtain management calculation and review it for arithmetical accuracy. Yes. Now 10% discount rate they used. 10% discount rate. Discuss with management the reason for using 10% discount rate to calculate present value of deferred consideration and assess the validity of their response. Are you able to understand it? Next. So two procedures are done. Now, discuss with management the management. Sorry, just 1 minute. Yes. Review the breakup of revenues of group and verify the molten companies revenues from theaters are increasing and likely to meet the criteria. Yes. Likely to meet the revenue targets to be qualified for deferred consideration. Now you see here, our focus is to verify whether this amount is payable or not. So 5 procedures are done. 6 we need to write. Still 2 things we have verified. Fair value of net asset is still there. Now, so obtain now customer list. Obtain the copy of valuation of customer list calculated by Morton Company and review it for arithmetical accuracy. First of all, obtain the expert report on the valuation of the customer list. Yes, and compare it with the valuation of management to verify its accuracy. 7 procedures are done. 6 are required. No, never write more than that. Never write more than that. Now, the last is conclusion paragraph. So, now, where we have to discuss the things. There are several significant risk of material misstatement. Now, what is the misstatement? Now, what is the highest? Now, I will be discussing conclusion only. And the consolidation of financial statement of subsidiary is the highest due to possible lack of experience of management. Secondly, the loan amount of 5, how much it was? How much million? Yes, that has huge risk. 458 million. Loan amount of 450 million. 458 million. And loan and covenant, and due to covenants attached with it, management has high bias that it may have manipulated financial statements. And the next amount is, yes, followed by government grant of 15 million, which may be repayable for not complying with its conditions. And other risks are followed. That is significance. Now it is done. So students, we will be talking about audit procedures. We have written on audit procedures. And you see here, each audit procedure has to be measured on certain criteria. You have to review your procedure. First of all, what do you want to verify? Purpose. Each procedure has its purpose. So I'll mention. So first of all, purpose. You want to wear a jacket, there is a purpose. You want to turn on air conditioner, there is a purpose. You want to eat something, there is a purpose. So purpose is there. And purpose here is, in this case, for the goodwill. We want to verify the actually that this 22 million paid. Actually, the purpose is to verify accounting treatments. Ultimately, board approval of acquisitions, the purpose. Arithmetical accuracy, calculation, it is correctly recorded. reasonableness of rate, discount rates. Ultimately, purpose is goodwill. Now, whether it is payable or not, to be qualified for that deferred consideration, again, payable or not, purpose comes first, and it must be part of procedure. Then there is source. Each procedure, bank statement and cash book, board minutes of the company, board minutes of the meeting of the company. Sorry. Now, obtain management calculations. Management is the source. Breakup of revenue of the group. Revenue from the theater are the source. Valuation of customer list by Morton Company. This is the source. Source. Each procedure has source. Then there is action performed on that. Action performed on that. Review and verify. This is the purpose. Review it. This action is performed on source. It is on the source. Obtain this, review it with purpose. Review it. Discuss is the action. Compare it is the action. Obtain and compare it. You should evaluate your procedures on it, on this criteria. If you do not do this, now, students, any questions so far about procedures? And I will be moving towards the notes. At the end, where the student is asking that where should be the conclusion? They have asked to report about, if you go to the question, so the report is for, yes. Actually, D part is separate. All other parts are related to audit planning. Okay, so audit planning we completely discuss and then write conclusion paragraph. It's better. This is the better approach. Good question. A student asked this question. The conclusion part should not be at the end of part B after this. So no, that's why we covered it. So A, B, C, conclusion should be at the end. It is separate. It is not related to audit planning. Okay, now, students, yes, audit procedures. So accounting issues normally, yes, there are procedure on it. In the question 1 of your paper, there will be a question most likely. 4 to 10 marks sometimes. To address, identify accounting issues. Recall IFRS criteria. Criteria we are verifying. Right procedure to verify the criteria. Right direction of work should be identified. Think each criteria point, how it can be verified. What could be the source of information? And procedures are here.